Hi everybody, and welcome back to video number 4 in chapter 16. And when we left off, we were looking at describing the accounting for investments in equity securities. And here, equity securities represents ownership of capital stock. So that cost is going to include the price of the security plus any broker's commissions or fees related to the purchase. The degree to which one corporation, in this case an investor, acquires an interest in the common stock of another corporation, the investee, generally determines the accounting treatment for the investment subsequent to acquisition. Okay, let's take a look. So, the levels of influence determine the accounting method. So, if our percentage of ownership is 0 to 20, the level of influence is little or none. Our valuation method then is going to be the fair value method. Now, if it starts to get significant in its level of influence, which of course usually around 50% is that demarcation, we're going to shift to the equity method. But if it's greater than 50%, and up to that, of course, 100%, then we have significant influence. We basically have controlling influence over the corporation, and the valuation method is going to be consolidation. So let's look at that. Holdings of less than 20%, I mentioned, we're going to use the fair value valuation method. We're going to recognize unrealized holding gains or losses in net income. Other income effects include dividends declared, gains and losses from the sale. Now, once we have a 20 to 50% ownership, then we're going to use the equity method of valuation, and unrealized holding gains and losses will not be recognized. And the other income effects will be a proportionate share of the investee's net income. Lastly, if our holdings are more than 50%, our valuation is going to be consolidation. Again, unrealized holding gains and losses will not be recognized, and other income effects will not be applicable. So, companies report equity holdings of less than 20% at fair value and record unrealized gains and losses through net income. The only exception would be for practicability reasons for determining fair value. Okay, so let's take a look at holdings of less than 20%. Here, upon acquisition, companies record equity securities at cost. So, on November 3, 2025, Amazon purchased the following common stocks of 3 companies, each investment representing less than 20% interest. Here's Nike, Tesla, and Nautilus, for a total cost of $718,550 in thousands. So that's going to be $718,550,000. Okay, now what does the journal entry look like? When Amazon purchases the following common stocks, we're going to record equity investments as a debit, $718,550,000, and cash to pay for it, $718,550,000. Now, on December 6th, 2025, they receive a cash dividend of $4,200 on its investment in the common stock of Nike. So a pretty easy journal entry here. We'll debit cash for $4,200 and credit dividend revenue for $4,200. Okay, now at December 31, we're going to assume Amazon's equity security portfolio has the following costs and fair values. So here's all the costs, $718,550,000 as we just described, but the fair value has fallen to $683 million. That's an unrealized loss of $35,550,000. And because there was no prior fair value adjustment balance, the fair value adjustment is the full $35,550,000. So the question is, what entry should Amazon make on December 31, 2025 related to its investment portfolio? And the solution is that for Amazon's equity securities portfolio, the gross unrealized gains are $15,300 and the gross unrealized losses are $50,850,000. So that results in a net unrealized loss of that $35,550,000. That is the fair value of the equity securities portfolio is below cost by $35,550,000. So I think it's pretty clear here. We're going to debit unrealized holding gains and losses dash income for the $35,550,000 and credit fair value adjustment for $35,550,000. So now assume that on January 23rd, 2026, Amazon sold all of its Nike common stock, receiving net proceeds of $287,220,000. They compute the unrealized gain on the sale. Here's what they received. And the cost was $259,700,000. So the gain was $27,520,000. So the journal entry then is going to be a debit to cash for what we received, $287,220,000. Equity investments at cost, $250,700,000, and then a credit to gain on the sale of investments, $27,520,000. So now we are going to assume on February 10th that they purchased 20,000 shares of Netgear at a market price of $12.75 per share, plus brokerage commissions of $1,850. So the total cost of $256,850. So their portfolio of equity securities as of December 31, 2026 was the following: Netgear, Tesla, and Nautilus. Now, the fair value at the end of the year are shown here at $779,950. So our previous fair value adjustment balance was a fair value loss of $35,550,000. So here we had a gain of $64,250,000. That change was $99,800,000, a fair amount. So what are we going to do? I think this is pretty easy to follow. We're going to make a fair value adjustment of $99,800,000 debit and then credit the unrealized holding gain or loss on income. And when we do that, we'll take that fair value adjustment from a credit balance to a debit balance of $64,250, which is the fair value of that portfolio. Okay, now we'll explain the equity and consolidation methods of accounting. Here, we're taking a look at holding between 20% and 50% using the equity method. So an investment, direct or indirect, of 20% or more of the voting stock of an investee should lead to a presumption that in the absence of evidence to the contrary, the investor has the ability to exercise significant influence over the investee. In instances of significant influence, quote unquote, the investor must account for the investment using the equity method. Okay, significant influence factors. You might have a seat on the board of directors. There might be technological dependency. There might be participation in policy-making processes. There might be an interchange of managerial personnel. There might be material intercompany transaction. All of that leads to significant influence. So, the equity method. We're going to record the investment at cost and subsequently adjust the amount each period for, bullet point 1, the investor's proportionate share of the earnings or losses, and bullet point 2, the dividends received by the investor. So if the investor's share of the investee's losses exceed the carrying amount of the investment, the investor ordinarily should discontinue applying the equity method and not recognize additional losses. All right, let's take a look at the Mylar Corporation. They acquired 30% of Board and Company for $120,000 on January 1, 2025. For the year ended 2025, Borden reported net income of $100,000 and pays a $40,000 cash dividend on December 31, 2025. How should Mylar record these transactions? So if we look at the solution, the entry to purchase the Borden Company stock, relatively straightforward, will debit equity investments in Borden for $120,000 and credit cash to pay for that. On December 31, Mylar must record its share of Borden's income and a reduction in the investment account for the dividends received. The entries are as follows. We're going to debit equity investments in Borden for $30,000 and credit investment income, that's 30% of $100,000, which will be $30,000. Then we're going to have cash, which will debit for 30% of $40,000. That's the cash dividend, and we got 30% of that. And the equity investments will be reduced by that $12,000. In summary, then, the investment account increased by $18,000, which explained the $30,000 increase based on Borden's share and Mylar's $12,000 decrease in its investment in the dividends received. The changes in Mylar's investment account changed relative to the change in Borden's company's total equity. And this shows the T account for the equity investments, resulting in a balance of $138,000. That looks like a good place to stop this video. And when we continue, we'll we'll move on from there.